All right, for more on the Fed and the QE Conundrum, we got to bring in Jim Frischling, New York Capital President. All right. I mean, we listen to Peter. Dennis is getting all busy and bothered over here because the numbers contradict each other. Where are we with all this?
It's QE
forever?
QE infinity, I was going to jokingly say. Actually, Wall Street has shifted its views considerably. If you think where we were at the end of the summer and everyone's speculating, based on the signaling of the Fed, that we were going to have a tapering in September. And now, fast forward, we're not even 2 months later, and where are we? No tapering, actually full bond buying through 2014. And I think 40% of the economists polled think we go bond buying into 2015.
Right.
So now you have to readjust your thoughts and say, all right, an additional $300+ billion of bond buying coming out of the market, keeping rates low. Where are you? How do you bet against stocks?
Okay, but let's get to your thesis, which is that the Fed's attempts to mend the economy are actually having backfiring effect on stocks because money's leaving stocks from pension funds in favor of riskier assets. Tell us about that. How's it backfiring?
Well, particularly, I'd say, first of all, for the savers and the fixed income investors, if you're not in stocks, first of all, you're getting zero on your money. So you got to get out of that.
Right.
And we're seeing a lot of money in the sidelines.
But that's been the story for how long now?
Correct. So now here's the next iteration of the process. Pension funds, endowments, looking at alternative investments, alternative investment managers. And yes, those guys do deploy money in the stock markets. They also actually deployed in ways that most retail investors don't have access to, buying companies, looking for cash flows across a myriad of vendors and service providers. These are investments that are far less transparent, far more opaque, except that's where some alpha is being generated.
And I got some figures for you here, Tracy. Listen to this. In state pension funds, 06 to 13, in 06, state pension funds had 61% of their assets in stocks.
Yes.
In 2013, they're down to only 49%. Yet the S&P 500 is up 23% this year. Aren't pension funds wrong to move money out of stocks into high-risk stuff when stocks are up 23%? What hedge funds up 23%?
Right. Well, what I'd say is that what we did see is the alternative investments have gone from about under 10, 12% to 24%. And it looks like, at least for some of the endowments, that's where they're getting the best alpha by investing
I think a lot of it has to do with planning. Right. To Dennis's point, everyone should probably be in equities because to your point, it's QE infinity, except that nobody really knows when they're going to pull the trigger. So everyone's trying to have that plan B, and you can't when these guys don't really want to tell you because I don't really think they know.
Well, the market has no ability to withstand any adversity right now. So it's the Fed on one side of the ledger and everything else. Weak economic data, weak employment, disgruntled, or rather, conflicts in Washington. The only thing keeping this thing up is, and they're doing it on their own right now, is the Fed. But meanwhile, balance sheets are getting stronger. Companies are pushing out their debt maturities, refinancing their debt, so they are getting better. So
well, why isn't that also keeping things up? Why is it only the Fed if companies are getting stronger?
And my hope is that if the Fed plays it right, which, by the way, huge task, and they're doing it on their own, but if they play it right, when they pull back, the idea should be the companies actually have repositioned themselves and should be doing better on the earning. So I don't want to be it can't be win-win. They can't have it both ways, but when they pull back, there will be a drop-off because, again, the market's not ready to withstand the Fed, overused cliche, taking the punch bowl away from the party. But the fact is these companies at that point should be producing better earnings, and our hope is the pullback is not so draconian.
But I think, Dennis, to your point, they're not doing anything because they don't know. I mean, who wants to invest in anything right now? You just don't know. They're positioned to invest in stuff, but no one wants to pull the trigger on anything, and that is why they are indirectly halting this economy.
Jim, I think one problem is having too much information and too much data in the short term that we forget about the longer term. Now, the International Monetary Fund just came out with a startling stat from the years 2003 to 2013, the last 10 years, average return for pension funds, 6.4% per year through the terrible meltdown of 08. And it shows you that over the longer term, things tend to go up. You just got to be balanced, and you got to have faith.
Stay in the course. And if you'd mistimed that, if you'd exited the market at a certain point of the crisis by your own investment decision or maybe forced out of liquid assets because you had to make other obligations, if you re-entered the market more recently, you would have missed all of that. You would have wiped out all. So you're right. Long term, you have to overweight stocks. You do need to add risk to your portfolios. The savers, again, I keep going back to that, who are getting zero, are being forced to deploy capital in those areas. And I think to your point about pension funds pulling back on some stocks, I think they are worried about what happens when the Fed does taper, which is why they've shifted into this alternative space, which I think is proving to be
losing out on 23% returns in stocks, those fraidy cats.
And if they go to 2015, like people are saying, that's what?
That's more up.
14 months of lost equity gains.
What she said.
I'd be mad.
Yes.
Huh, I am mad. Jim Frischling, thank you, sir.
Thank you very much.
What's our pension plan invested in? It better be all equities. You should check
Yes.
that.
I have I put 100% right in 21st Century and News Corp stock. That's the way to go.